Ever feel like picking stocks is a guessing game for the rich? You're not wrong. But what if I told you billionaire Warren Buffett himself favors an investment strategy and it's surprisingly accessible? It isn't about chasing risky trends. It's a simple, low-effort way to build serious wealth for retirement. Curious how just a few $100s a month could snowball into $1 million? In this video, we will discuss the ETF and see how the VOO, Warren Buffett's go-to investment, can be your key to retiring richer. ETFs are investment toolkits offering a convenient way to dive into the stock market. With just one share, you're spreading your risk across a bunch of different stocks. Some ETFs are broad, covering many industries or the entire stock market. Others are more focused, honing in on specific sectors or market niches. Among the heavy hitters is the S&P 500 ETF. It tracks the S&P 500 index, a benchmark for the overall market. It's got 500 big-name stocks from various industries, giving you a taste of the whole market in one shot. Even Warren Buffett, the investing maestro, is a fan. He's got his money parked in S&P 500 ETFs through Berkshire Hathaway, and his favorite among all is VOO. If it's good enough for Buffett, it's worth considering for your portfolio too. Now, it's interesting to note that Berkshire Hathaway has a larger stake in the Vanguard S&P 500 ETF than others. As of the end of the third quarter of 2023, Berkshire's investment in VOO was valued at over $17.5 billion, while its position in SPY was less than $17.5 million. Buffett's preference for S&P 500 index funds was clear in his 2013 letter to Berkshire Hathaway shareholders. In it, he stated that he had directed most of his family's inheritance to be invested in a low-cost S&P 500 index fund, specifically recommending Vanguard's offering. But why does Buffett prefer this? Before we know the answer, let's learn more about VOO. VOO is like the ultimate cheat code in the stock market game. It's an ETF that mirrors the S&P 500 index, giving you a slice of the 500 most giant dogs in the U.S. corporate yard. When people talk about the market being up or down, they often refer to the S&P 500, so VOO is like your backstage pass to that action. Now, why is VOO so popular? Well, it's like the adrenaline junkie of investments. Its value can skyrocket or nosedive faster than funds in less risky bonds. It's not for the faint-hearted, but if you're in it for the long haul and hungry for those big returns, VOO could be your ticket to the wealth train. Bonds might be cozy, but stocks are where the real growth happens. Let's talk strategy. VOO is your go-to if you're playing the long game. It's like planting seeds and waiting for a forest to grow. But while VOO doesn't throw dividends at you like confetti, it is a wealth-building machine. Now, about VOO's portfolio. It's a blend of value and growth stocks, giving you a taste of everything. Since it shadows the 500 big players in the U.S., it's like a VIP pass to the hottest corporate parties. Peeking under VOO's hood, you'll find some heavy hitters. Microsoft's throwing its weight around with a solid 7%, while Apple's right behind at 5.63%. NVIDIA flexes its muscles at 5%, and Amazon holds its ground at 3.7%. Meta, formerly Facebook, is in the mix at 2.4%, with Google and Berkshire Hathaway both making respectable appearances. And don't forget about Eli Lilly and Broadcom, they're in the ring too, each making up around 1.4% and 1.3% respectively. Regarding sector concentration, the information technology sector is taking the cake, making up about 30% of VOO. Financials are next at 13.3%, followed by healthcare, consumer discretionary, and others. Meanwhile, sectors like materials, real estate, and utilities are bringing up the rear. But it's no surprise that information technology is leading the pack, considering the tech giants in VOO's lineup. These holdings are just the tip of the iceberg, though. 490 more stocks are waiting in the wings, so you're getting a ticket to the whole show whenever you invest in VOO. Sure, you won't see another behemoth like Microsoft with its 7% share, but all those smaller holdings create a diversified portfolio. Buffett has a knack for keeping things simple, and when it comes to investing, he's all about minimizing costs. That's why he's a big fan of the Vanguard fund over others that might own the same stocks. The reason? Cost. Vanguard is known for its low annual expense fees, and Buffett's all about keeping those costs minimal, as he emphasized in his 2013 letter. When comparing VOO and SPY, VOO comes out on top in the cost department with an annual expense ratio of just 0.03%. It's a steal compared to SPY's 0.0945%. And while these ETFs might only make up a tiny slice of Buffett's massive portfolio, he's repeatedly stressed that similar investments should make up the lion's share of yours. Buffett's mantra seems to be, keep it simple, keep it cheap. At Berkshire Hathaway's 2020 annual meeting, he made it crystal clear, owning an S&P 500 index fund is the way to go for most folks. Why? Because trying to pick winners in the stock market is like playing darts blindfolded for many investors. But with an index fund, you're getting exposure to the entire U.S. market's historical growth trajectory, and all for a bargain price. Buffett says, don't stress about finding the next big thing. Instead, play the long game by consistently investing in the S&P 500 and doing it in the most cost-effective way possible. That sounds like solid advice from the Oracle of Omaha himself. The VOO ETF might be your secret weapon for achieving financial freedom sooner than you think. Being worth more than $430 billion, the Vanguard S&P 500 ETF is one of the biggest on the market. Let's dive into why it could be a powerful tool for your retirement journey. Resistant to inflation. VOO is like a fortress against the ravages of inflation. When you invest in this ETF, you're essentially pooling your money into a collection of top-tier American companies renowned for their dividends and rock-solid market positions. Look at names like ExxonMobil, Chevron, PepsiCo, Coca-Cola, Visa, MasterCard, and Apple. These aren't just any companies, they're behemoths in their industries, known for their stability and quality. ETFs remain remarkably resilient, even in the face of potential economic challenges like the looming specter of inflation in 2024. When inflation rears, the prices of goods and services tend to climb, which can spell trouble for traditional investments like stocks and bonds. But ETFs are a different breed. They typically hold diverse assets including stocks, bonds, commodities, and real estate investment trusts, REITs. And some of these assets, like commodities and real estate, have a history of performing well during inflationary times. Take commodities, for instance. When inflation kicks in, investors often flock to commodities like gold as a haven to preserve their wealth. The logic is simple. Tangible assets like gold tend to hold their value or even appreciate when the dollar loses its purchasing power. And let's not forget about real estate. That's another ballgame. When inflation kicks in, rental income and property values increase. And guess what? VOO is packed with holdings that can weather economic storms like champions. Take Johnson & Johnson, PepsiCo, and Coca-Cola, for instance. They're like the superheroes of the market, especially during tough times. Johnson & Johnson in particular deals with essential medicines, so even in a crisis, their products fly off the shelves. And you know what? Healthcare companies in the ETF can tweak their prices as needed because people will consistently shell out vital healthcare stuff no matter the cost. Long-term growth. You know about planting a seed, right? You plant it and nurture it with water and sunlight, but you wouldn't expect a giant oak tree to sprout overnight, right? Investing in the VOO ETF for early retirement is similar. It's a long-term play, and the S&P 500's historical performance suggests the potential for significant growth over time, allowing your nest egg to blossom steadily. Let's take a closer look at why the VOO ETF is built for long-term success. Compound interest is often called the eighth wonder of the world by Albert Einstein, and for good reason. It's like earning interest on your interest. The longer your money stays invested and grows, the faster it accumulates. The VOO ETF allows you to harness this power by staying invested for the long haul. Moreover, short-term market fluctuations can be unnerving. The news might be filled with scary headlines about stock market dips, but with the VOO ETF, you're not playing a daily game. You're investing in the overall health and growth of the U.S. economy, which tends to trend upwards over extended periods. Risk-free. VOO is the Fort Knox of investments, especially in the long run. Warren Buffett, the big boss of Berkshire Hathaway, knows a thing or two about risk. He even believes that the CEO of any large financial institution should double up as the chief risk officer, making sure the ship is built to weather any storm. And he's got a point. After all, risk is about the possibility of losing everything, not just taking a dip in the market. Let's break it down. Imagine a scale with U.S. Treasury bonds on one end and the VOO on the other. According to the S&P, Uncle Sam has less than 0.3% chance of defaulting on his bonds in the next 30 years. But when you look at VOO, it's stacked with heavy hitters, the big dogs of the market. The chances of all of them tanking to zero? Slim to none. So where's the risk in VOO in the long haul? Absolutely nowhere. But what about dividends, right? Aren't they risky compared to the rock-solid income from U.S. Treasury bonds? Not really. Sure, Treasury bonds are as safe as houses, but what about VOO's dividends? They're like a fortress. The ETF has got strict rules to ensure its investments are top-notch, and many of the companies it holds have a solid track record of paying dividends. Plus, it's in bed with the dividend aristocrats, companies that have been upping their dividend game for at least 25 years. So when it comes to dividends, VOO's got your back. Low cost. With an expense ratio of just 0.03%, VOO keeps costs minimal. For every $10,000 you invest, you'd only incur $3 annually in fees. That's a bargain compared to other investment options. Now here's where things get interesting. Imagine investing $150,000 in VOO and reinvesting the dividends. With a dividend yield of 1.36% and a growth rate of 5.81%, your investment would grow to approximately $152,040 with a profit of $2,040 after the first year. But hold on, it gets better. Fast forward a decade, and your investment would double, reaching around $412,950. And after 2 decades, your initial $150,000 investment would skyrocket to approximately $1.92 million with dividends reinvested annually. That's like hitting the jackpot, and the wealth-building journey doesn't stop there. 30 years later, you'd be sitting on $5.1 million. That's how the Oracle of Omaha keeps amassing billions through savvy investments like VOO, paving the way to long-term financial success. Ultimately, we can say that retiring early with VOO is not just possible, it's highly achievable. With that said, let's wrap it up. Stay tuned and subscribe for more amazing videos.